Hello and welcome to my next video. This video, and it'll probably need to be split into parts, but this video is going to talk about one of our last topics for the semester, not the last, but one of the last, monetary policy. So what are the tools of monetary policy? Well, funny you should ask. Here they are. Changes in the discount rate, changes in the required reserve ratio, usually just called reserve ratio, and open market operations. So what in the world is the discount rate? The discount rate is the rate that the Fed charges banks when banks borrow reserves directly from the Fed. Banks are required to keep reserves against their checking account deposits, savings account deposits, so they're deposits. And that reserve ratio, that percentage, is determined by the Fed, and it does vary depending on the size of the overall deposits in the banks and other things. But anyway, there are reserve ratios that are required by the Fed for banks to hold on in terms of reserves. Now, those reserves, what if a bank runs short of those reserves? Well, one avenue they have to cover the shortfall is to just borrow directly from the Fed. So when a bank borrows reserves directly from the Fed, then the Fed charges them an interest rate on those funds. The Fed actually discounts the loan amount, how much the bank is borrowing, by the amount of the discount rate. So that's why it's called a discount rate. In other words, the interest rate is charged off the top of the loan. So the Fed can directly set that. So if the Fed wants to signal interest rates should rise, they can increase the discount rate, or if they want to signal interest rates should fall, they can lower the discount rate. Now, speaking more of that required reserve ratio, the Fed, within, again, certain boundaries, sets limits on that percentage of reserves that banks have to hold against deposits. Now, there's two forms of reserves, recall. There's cash in the vault or on account with the Fed. Banks, at least national banks and a lot of state banks, and some other financial intermediaries will hold reserve accounts with their regional Federal Reserve Bank. And so that's what we're talking about. So how much are they going to hold in that form and in cash and vault? Those two together have to add up to meet the required reserve ratio. So if the Fed increases the required reserve ratio, that means banks have fewer excess reserves. They have to keep more required reserves so they can make fewer loans. On the other hand, if the Fed lowers the required reserve ratio, then banks don't have to hold as large a percentage of reserves against the same level of deposits, so they can make more deposits so that they can make more loans. And so that's how reserves are affected by a change in the required reserve ratio. And last but not least, in terms of traditional monetary policy tools in the United States, is the open market operations. Now, these operations are conducted by, strangely enough, the Federal Open Market Committee. So that's a group within the Fed. Go back and look at the structure of the Fed. That actually directs the employees, the people working in the open market operations area, which is, by the way, at the New York Fed. And they direct the personnel to either buy bonds or sell bonds. Now, it's not all bonds, but it's primarily government debt. And so by open market, what we're meaning is these are not newly issued government bonds. That would be the primary market. They're actually going on the secondary markets. In other words, bonds can be resold after they're first issued and purchased. And so that's called the open market. And so that's where the Fed is either buying or selling bonds. So make sure you understand this would be like buying or selling a used car as opposed to a new car. So that's kind of similar. Now, these open market operations, the way the Fed actually pays for, let's say, an open market bond purchase is they create reserves out of thin air. Yes, you heard me right. Those reserves are created out of thin air. What the Fed will do is whoever they're purchasing these bonds from, there's actually some called primary security dealers. They usually don't just buy them all from one dealer, so they'll figure out the best deals. The Fed I'm talking about. Then they will decide, okay, from this security dealer, which a lot of times it's one and the same as the bank, or if not, the security dealer banks through a major company, major bank. We'll purchase X amount of dollars from this security dealer and X amount of dollars from this other, and so on and so forth. So the way they actually pay for this purchase, are you ready for this? They go over to a computer, open up the reserve account for the bank that this security dealer is either the bank themselves or this security dealer banks with, and they say, okay, boop, you now have more reserves. The Fed literally creates reserves out of thin air to pay for purchasing these bonds. So I kid you not, that's really the way it happens. But that's reserves, just like cash in vault. So that they're the bank I'm talking about, for which the business was conducted through. Now the bank has more reserves; they can make more loans. The money supply increases. So you say, but this is just a computer entry. What if banks need cash in bulk? Not a problem. It's a Fed that actually conducts the process of distributing money and bringing it in when it's no longer useful. It's too old to be used. So that's not a problem. I promise you that's not a problem. Now, if on the other hand the Fed sells bonds, again, other securities are used, but let's just go with bonds. Then the open market operations employees withdraw those funds from the bank, the reserve account from the bank that is associated with a security dealer. So therefore, there's fewer reserves in the banking system, and so the bank can make fewer loans. So let's make sure we're clear. If the Fed buys bonds, that's open market purchases, there's more reserves into the banking system. In other words, reserves are ejected in the banking system. All right, the money supply goes up. If the Fed sells bonds, then reserves are withdrawn out of the banking system. Fewer reserves, can't make as many loans, money supply goes down. So make sure that you're clear on buying bonds, selling bonds. All right, now I want to talk about the perspectives on how monetary policy actually has an impact on the overall economy, the macro economy. And there are there's way more than this, but there are two basic viewpoints about how the actions of the Fed, the central bank, impact the economy. There's a Keynesian view, and then there's a monetarist or classical view. We could call it neoclassical too, but then that involves a little of the Keynesian analysis. All right, so recall when we looked at money markets, interest rates, short term at least, interest rates are determined by the interactions of supply and demand for money. And so if the Fed wants to, for example, increase interest rates, they would decrease the money supply. That would be a leftward shift in the money supply. Remember, it's vertical because the Fed determines the money supply. And that would tend to increase at least short-term interest rates. That would happen during an expected demand pull inflation. The Fed would want to lower interest rates, cut interest rates when they perceive that the economy is going in or is already in a recession. So typical recessions are caused by a drop in aggregate demand. So again, the Fed, what they would want to do in that case is increase the money supply, and the way they would do that is by decreasing interest rates. How do they decrease interest rates? By increasing the money supply. How do they increase the money supply? Either by lowering the discount rate, so banks borrow more, they can make more loans, cutting the reserve ratio, the required reserve ratio. Banks have more excess reserves, they make more loans, money supply goes up, or they go in open market operations and buy or purchase bonds. So any of these. And the old term for this was Expansionary monetary policy, you'll also hear it termed an easy monetary policy, or you can also hear it called a monetary stimulus. So the Keynesian idea of how the actions of the Fed get transmitted into affecting the actual economy, in other words, real GDP, employment, and prices, is, for example, if we're needing to pull out of a recession, they would increase the money supply, that would decrease interest rates, which would increase investment and consumption spending. So you lower interest rates, business firms find it cheaper to borrow to make more investments. Consumers, households can buy stuff more cheaply on credit. And so that both of those should stimulate aggregate demand. Keynes, in his early analysis, actually focused more on investment spending. So that's really where he focused, was on the relationship between interest rates and investment spending. And Keynesians believe that investment spending is a negative function of interest rates, but not a strong function of it. So an increase in the money supply increases the quantity of investment spending some, which should shift the aggregate demand curve to the right to pull us out of a recession. That's the Keynesian viewpoint of how the Fed should conduct monetary policy when we're in a recession. Now, on the other hand, if we're looking at demand pull inflation, then we would do just the opposite. The Fed would want to decrease the money supply. That would increase interest rates. Let me just go on to this one. Decrease the money supply, increase interest rates. That would decrease investment and consumer spending and shift the aggregate demand curve to the left. So those are the basic tools of the Fed in conducting monetary policy. And there are a couple of new tools that the Fed has used, at least since 2008. And one that you may or may not have heard of is quantitative easing, and the other is modern monetary theory. Quantitative easing is basically the idea that the Fed felt like when we went into the deep recession in 2008, that the Fed basically had exhausted all they could do, and they got interest rates close to zero, and the economy was still in a recession from their perspective. And so, what else can we do? Well, instead of just purchasing, and it's mainly short term um, notes and bills, and then bonds, government bonds are long term, but they would only hold on to those for a very short term, like quite often just a day, but that's another story. Instead of utilizing those traditional tools of monetary policy, why don't we actually just start buying other forms of debt? We might even buy commercial paper that's short term debt instruments from businesses, longer term corporate bonds. We might actually deal directly with those big corporations as opposed to those primary security dealers. And so that became known as quantitative easing. We went through several rounds of quantitative easing. And what this really did is the Fed ended up with a huge amount of securities on their balance sheet. In other words, their assets, those are assets from the perspective of the Fed, increased dramatically. And then as inflation started really heating up, they started to reverse this quantitative easing. I don't know really that they've been that successful in damping down the inflation. I'll let you decide on that. The research actually is mixed on the impact of quantitative easing. Then modern monetary theory, it's been around a little while, but it has only gained really notoriety in the last few years. As I understand it, modern monetary theory basically is the idea that if you have a reserve currency in terms of international exchanges of currencies, and definitely, at least at this point, the United States dollar is the de facto world international reserve currency. Then, if you have an international reserve currency, people all around the world are happy to hold on to your money, in this case, dollars. And so the idea of modern monetary theory is that the Fed, the central bank, can basically spew out as much money as they want to, and it will be absorbed around the world because of that reserve status. And therefore, any kind of possible inflationary impacts will be widespread, so that should not generate a whole lot of inflation domestically. This is my own personal opinion. I think this is totally false. And I think we've seen the increase in inflation. So I certainly, just personally, don't believe in modern monetary theory. However, I will tell you, a lot of people smarter than I certainly hold it credence in it. And so, like I say, they're smarter than I, so who's to say? Well, that's kind of a brief, I know it doesn't seem like it's brief, but a brief introduction to monetary policy.